We start with China. What could drive gains?
Well, I think it's simply that there's just so much negative sentiment priced in that Chinese equities could get a nice boost from any policy stimulus. And we've heard that there could be some coming, there's likely to be some coming, and that could be a nice boost in the shorter term.
Is it also a relative growth story, especially against the U.S.?
I'm not sure if it's a relative growth story right now, but it could be. I think we need to see more in terms of policy stimulus and, of course, the impact on sentiment, which I think is critical for the Chinese economy. But certainly there is that potential. I think in the U.S., it's a very different story. You know, I've been in the camp all year that we're going to have a bumpy landing. That used to be an optimistic view, but strategists and economists have shifted so much to the point where most are in the soft landing camp that I now seem pessimistic. But I think the reality is there is no way the Fed can do the level of tightening that it's done so aggressively and not have some damage. And that's why I believe it's going to be a bumpy landing.
What happens if Treasury yields continue to rise, and how are you positioning ahead of U.S. CPI numbers?
So we try not to take a very short-term view. Our expectation is that we are very much in a disinflationary trend. There's that quote, life's a journey. Disinflation is a journey too, and we're in the midst of it. It's going to take some time, but it is, a very, very significant trend taking hold. So we might not get every CPI print looking perfect, but we're moving in the right direction, and that will continue. Our expectation in terms of equities is that we could see some headwinds for U.S. and other developed markets, but particularly the U.S. in the near term. There's some digestion that's likely to occur after a strong rally, but also as the stock market prices in something more realistic in terms of when rate cuts are going to start. I think there's a little too much optimism that rate cuts are going to start very soon, and I'm not sure that's going to be the case. In fact, I think it's unlikely. But then we're likely to see stocks start to discount an economic recovery because I do think this bumpy landing will be relatively brief.
Kristina, if this is a long-term journey and obviously an uncomfortable one in parts, if we're talking about, potentially sustained disinflation elements, a Treasury is a good place to be at the moment. You've got the likes of JP Morgan, Goldman saying, buy up. Is 4% plus compelling enough going into these auctions?
Well, I'm a big believer in diversification. So we want to have adequate exposure to fixed income, but that means investment grade credit, which looks very attractive, certainly some treasuries, and locking in the longer term yield makes sense. But again, I think it's all about being well diversified, because before you know it, we could see markets starting to discount that economic recovery, which could bring about more interest and better performance for high yield, for example. So I think of fixed income as a very attractive area right now after years of very low yields. There's a lot to choose from, and I think we want to have a diversified stable of fixed income asset class exposures.
And, we talked a little bit earlier about China, and obviously Japan has become the popular alternative to a lot of the foreign flows that would have otherwise been in China. Is it an either-or proposition? Because the narrative for Japan seems to be, well, the BOJ policy overhang is gone now, so full steam ahead for further gains.
Well, I think we want to be cautious in the shorter term because arguably most, if not all, the good news is already priced in. And we could have some downside in terms of policy support, certainly from a very, very accommodative level. But still, that could create some headwinds for Japanese equities. The opposite is the case for Chinese equities. But I don't think it's an either or because, as I said, I believe very strongly in being broadly diversified. And that's both in fixed income and equities, as well as alts.